Hi, I'm Dominic Picardo here for the February edition of Spreadbet magazine, and today I'm asking whether it's time I got a life, or more accurately, got a life insurer. That's right, I'm weighing up the benefits of a trade involving the share price of Legal & General, the FTSE 100 life insurance giant, which, as you can see, has been in this powerful uptrend ever since these depressed lows of March to 2009. Now, at that point, of course, the world seemed to be on the brink of another Great Depression, and the LNG had shed 88% or so of its value. Since then, of course, the share price has really come back with a vengeance, much more so than the rest of the stock market, in fact. Lately, it's got back to pretty much where it was back in the summer of 2007, before the credit crunch first bit. So, is it worth our trying to get involved here, or have we already seen the best of the gains? Well, first of all, we have to consider the big picture. And for me, life insurers are a good play in a rising stock market. The likes of LNG are themselves heavily involved in the in equities, and therefore rising equities often feed through into share price strength for them too. The beta of the sector, of the life insurance sector, is traditionally greater than one, meaning that a 1% increase in the share price or in the all share index will generally feed through into a greater than 1% gain in the sector. That is in life insurers as a whole. And obviously, the same applies when we are talking about a market which is on the way down. The sector, the life insurance sector, will tend to fall by more than the market itself during a down move. So, I'm bullish on the outlook for the FTSE 100 as a whole. I think the index is significantly undervalued and has a lot of catch up to play. And I think that investors are generally also too bearish about the outlook for this year, that stocks could therefore surprise. So in this environment, I can see LNG continuing to rise along with the stock market as a whole. At the same time, I am mindful that a lot of people will be concerned that we're closing in on the sort of highs that we saw in 2007. Often markets do experience a major failure when they get back to previous significant highs such as those. However, what I would point out that at this high here back in 2007, and also if we go back to the highs of the pre 2000 top, then this company was significantly higher, more highly valued at that time. So, which thereby made it more vulnerable. This time round, we're not as highly valued. The dividend yield is still over 4%, which is about in line with the long-term average, which is, as far as I see it, it's a reasonably attractive feature of the stock. So I'm not worried about the prospects for a major top. Another thing on the technical side, which I'd be looking for or looking at, would be long-term momentum, and this here is represented by the monthly relative strength index, which hasn't yet reached overbought levels at 70%. And even when it does, the first time it does seldom marks the absolute top of the market, such as we see here in 2006 or so, and then the market doesn't top until 2007. There's another nice bit of upside. We get the same sort of thing in 2000. It's not the peak in momentum or the first time that momentum becomes overbought on the long-term view. It's a couple of peaks in from there. So, technically speaking, this uptrend remains in good shape as far as I see it. Clearly, it's the best of the gains occurred here and here. So I'm not expecting massive upside from here, but I still think we could approach maybe the sort of 168 and 179 levels as the in the period ahead. If we just focus in on the period since summer, the June lows of last year, you can see this has been a nice, steady sort of uptrend, and for me, this is a nice sort of market to trade. A nice, smooth uptrend that we can join at opportune moments. And this blue line here is the 55-day exponential moving average, and you can see a couple of times the market has come to rest around this line and then picked up again, and those would be my preferred entry points. As long as this line is rising and the market bounces off that level or through there, then I would be seeking to get long. I'd also settle, frankly, though, for a more modest dip that doesn't even reach there. Something which takes the daily relative strength index down to around, say, the neutral level, around 50% or so on here. So that those for me would represent good short-term spread betting opportunities. And what's more, then again, we might get, and I do expect at some stage we're going to get a larger shakeout in the stock market this year, maybe another 5 or 10% off, which I think will create another great buying opportunity in equities as a whole. But given the tendency of life insurers to bounce by more than the market, I think L&G in that situation after a correction could make an especially interesting recovery play.